So many lagging sectors have ripped over the past 6 weeks, from banks to materials to industrials and so much more. Is the better breath just beginning? That's the key question. Let's ask Adam Parker, founder and CEO of Trivariate Research, a CNBC contributor. He's here at Post 9. Welcome back.
Thanks. Good to see you.
Let's take stock of where we're at, because we've come a long way over the last visits that we've had, over the last 6 weeks or so. What's the message of all this, do you think, to you now?
To get that broadening rally you teed up, I think you need to believe profit margins can expand for the average company. That's what you need to believe. Most of our work has been focused on gross margins, the costs around materials, depreciation, labor, pricing, mix, all those things. Can companies' profit margins can expand?
Can they?
I think they've troughed here at in the last, after being reset up, they troughed here recently, and I think they can. I think there's many companies, lower logistics costs, better productivity, a little bit less wage pressure, can maintain the pricing they've already taken. I think they can, and I think, it's not a slam dunk, but I think a lot of them will be able to. And if the median or the average company can, maybe that's the ballast for, a surprisingly good market again next year. And you're starting to see guys who did their year-end outlooks in November already raise their price targets a month later for next year.
David Kostin, highly respected strategist over at Goldman Sachs, like a month ago was at 4,700 for 2024. For his S&P target, he goes up to 5,100. Better, macro backdrop. Economy doing well, you can actually support higher multiples for stocks. Do you agree? Sounds like you do.
I think, I think the distribution of outcomes is probably skewed to the positive for next year versus what the big firms are saying. But I think it comes down to belief margins can expand, and I think it comes down to what the Fed does. It looked to me like the big firms who got more bullish already were responding to the Fed pivot a little bit more than the earnings outlook, but it's hard for me to parse exactly what people are saying. My own personal view is the case for market breadth and a really good market is margins expand, and you just start believing that earnings are going to grow for the next few years in a row. And then all of a sudden what looks cheap on 26 or 27 might look a little expensive on 24. And I think that's what happened. If you look back a decade ago, earnings grew all the way to 2019, and people were, it's expensive in 2011 and 2012, and it worked out well. So I think we could be setting up for earnings doing fine for several years again.
Do you think the market's over its skis in any way and how it reacted to the Fed? I mean, I asked that in the context of the market has gotten it right largely as it relates to the Fed. The market sort of guiding the Fed rather than the Fed necessarily guiding the market. The market had priced in cuts. The Fed came to the market. Right?
Yeah.
So now it's a question of when are they going to cut? It's not even that. We've been raising the question on this program or the idea that who cares as long as they cut for the right reason, not the wrong reason. The right because they can, the wrong because they have to.
Right. I think, if you get 6 cuts or whatever's in the price, it's probably because it really got worse than it's expected. And I don't think there'll be smooth sailing through that. If they do 2 or 3 times in the second half of next year, I think that's the right, kind of risk reward for equities. But I think if they have to, because you get, much worse employment trends, that would be, that's all bets off. Right? Yeah. So I don't think that's what we're talking about. I think we're talking about, they stamp out the worst part of inflation. If I look at equities, which I focus on, things like home builders and select retailers and semiconductors and electrification industrials have all ripped. We wrote about that in our note this week.
Home builders like all-time highs. Semi-trade's been one of the hottest of the year, a space as well, if not better than most, given your prior career as a semiconductor analyst.
Yeah, I look at all, and I think, what most people I'm talking to in my meetings think we're going to have a pretty big rotation in January. It happened last year because, you remember, it seems like 10 years ago, but Meta and Tesla and NVIDIA were awful stocks in 2022, and they troughed on January 3rd, the first trading day of this year, and they've had great years this year. So I think people are trying to figure out what's hated that could benefit. Is it healthcare, which everyone just thinks automatically will be better? Is it payments? Is it maybe it's energy materials, which are been annihilated.
You're on that bandwagon now, right? I mean,
could they benefit? Yeah, look, I'm tethered to a view that where demand will exceed supply for oil in the medium to long term. It's very hard in a 6-month view to get the oil price right, as we've seen over and over again. It's at the nobody knows nothing camp in terms of that view. But I don't see how we can produce what we need given demand. So I like that, and the question is, will it benefit in rotation in January? We'll see. What I can tell you is a recession is more in the prices of energy or materials than it is in Lululemon or Mercado Libre or other, consumer-facing entities where the, where the stocks are top left to bottom right.